Getting rich with dividends, dividend riches. It's hard to believe, but this is video number 200 when it comes to my dividend investing videos here on PPC Ian. And to celebrate this milestone, today's video, I am going to get real with everyone here. I have a topic that I want to discuss today that I really think gets to the core of dividend investing, and it kind of illustrates how getting rich with dividends, especially in a shorter period of time, there are trade-offs when it comes to risk. Moreover, dividend investing, oftentimes in the bull market, in the market that we've been in, it's kind of easy. Stocks have been going up and to the right. And so from an emotional standpoint, as a dividend investor, it's smooth sailing. But it's not always that way. Subscribers on my channel, they've asked me so many times, Ian, you lived through it. What was the crash like? What was the crash like? Was it scary? Was it emotional? How did you deal with it as a dividend investor? In fact, there is a sub-segment of stocks right now that I actually own in my dividend portfolio that really, in my opinion, embody a crash-like scenario, both from stock performance, but also from media, from the voice of the media and what they're doing to this segment of stocks. And so there are going to be so many insights in today's video, all centered around this idea of dividend riches, risk, getting scared, and of course, because this is video number 200 and you know I'm a thug, there's going to be some thug life investing in today's dividend investing video. So let's get started, everyone. So if you haven't guessed already, today's video is about sin stocks. Well, it's about dividend investing overall, but I'm using the example of sin stocks. And I've received a question, even today, I get so many comments. By the way, I'm getting a little slower these days to respond to the comments just because there are so many, but please keep them coming. I will get to most of them. I love you guys. Thank you for the comments. But there was a comment today on my channel, Ian, what do you think about Altria? It is down 4.5% today. It's kind of dipping down again. It's dipping down again. What do you think about this? So I'm going to get into that, but let's start off here. What's the crash like? A lot of people asking, Ian, what's the crash like? We're going to have an upcoming correction or crash. What is it like? What should I expect? And I want to ask you, do you own any of the sin stocks right now? Do you have kind of a position in the sin stocks that is relatively meaningful to your portfolio? Well, if you do, you're probably already starting to understand what the crash is like in some respects. And I'm going to tell you, these are sin stocks, in my opinion, are solid companies. Margins are really good. Historically, the companies have performed very well. In fact, Altria, in some studies, is indicated as the best performing stock of all time. And they have great numbers, more or less. But these companies are facing challenges. Now, what's interesting with these companies right now is the challenges aren't really internal, it's external. Everyone in the world is coming after them. They're coming after these guys. They don't like them, or at least that's what the media leads us to believe. And so when you ask me, Ian, what is the upcoming crash going to be like? What's it like? Well, in many respects, if you look at the sin stocks right now, you will know what the upcoming crash is going to be like. You're going to have good companies, good numbers, historically good performers, stock prices are way down, and they're going to be facing some challenges. And challenges come in many ways. Like I said, right now for the sin stocks, they're external challenges. We'll get to those in a minute. But the companies themselves, if they didn't have all these people coming after them, they would be flourishing just fine. It is all of these external challenges. But sometimes it's an internal challenge. So, for example, I'll take example 3M. During the next recession, we might already be seeing this a little bit with 3M being a leading indicator. It may be more internal challenges in the sense that not everyone's coming after 3M, but sales are down. And sales are down a bit because B2B sales during a recession, a lot of businesses are going to push those types of big purchases out. Anyways, that's what it looks like from a fundamental basis in a downturn, in a crash. But also what happens in a crash, and I really want to underscore this, is the media and horrible sentiment. And this horrible sentiment honestly can eat away at you as an investor. And so you see it right now with sin stocks, and that's why I'm using this example. But what's interesting is during a downturn, the media, they're attacking the whole stock market. They're attacking the whole stock market, and there is this sentiment that you would be crazy to invest in stocks. Investing in stocks would be such a bad idea. And the media hypes that message up so much that even the most seasoned investor like myself, it can get into your head. Quite frankly, that is one of the reasons I created this channel on YouTube, is to provide more of a level-headed opinion on what's going on. But I'll tell you, taking the sin stocks right now is a microcosm. People asking, what's the crash like? It's like what's happening to the sin stocks right now. The media would lead you to believe right now that it's over. The game over. No more sin stocks. Sorry guys, they are going under. But let's talk about that for a minute. There's a lot of bad stuff. Bad. There's this guy, Scott Gottlieb. He was the commissioner of the FDA. A few months ago, Mr. Gottlieb decided to leave the FDA. He wanted to spend more time with his family. He left for personal reasons. Anyways, when he was at the FDA, he is basically trying to go after these sin stocks. One thing in particular he was doing is trying to ban menthol, which is a flavor that is used especially by a stock I own called BTI. In their acquisition of Reynolds American, they picked up the lion's share in the United States of the menthol market. Anyways, he is no longer at the FDA, and in the press, the story, it all reads, oh, he left due to his own reasons. Now, I don't know why he really left, but that seems a little coincidental to me, that he just said, I'm on a mission against these companies, I'm going to take them under, and then, whoop, I'm out. I'm going to go spend some good quality time with my family. It just didn't, it seems weird, but look, I don't know all of the story. But anyways, what happened today? Mr. Gottlieb, you're not even at the FDA anymore, yet you're speaking up. And he said, I'll give you the background on this in a minute, but JUUL, this is a company that Altria has a big stake in, that they bought not long ago, I think like $12 billion stake, is going to be in a hard spot to ever get their product approved. So what does this mean? Basically, one, Mr. Gottlieb, look, you're not in the FDA anymore. Why are you getting in the media? Or why is the media seeking out your opinion? Because bad sentiment. Media, it sells more stories, it creates hype. Maybe there's an agenda behind all of this. I don't know, but this is what it's like in a crash-like environment. The media, they try to get into your head. And so, anyways, what's going on with JUUL? Taking a step back. So Altria is a company that I own as well. They purchased a big stake in JUUL. Now, JUUL, the product that they sell for a long time now, it has basically gone, to my understanding, without FDA approval. It's kind of not fallen into the historical guidelines of the FDA. Well, all of a sudden, the FDA is facing some issues. I think there's like a lawsuit against the FDA because they didn't regulate this thing. Anyways, to kind of fix things up, the FDA is saying, hey, JUUL and other similar companies, you have 10 months to come to us with a plan on why we should approve your product. And there's actually a judge now being kind of aggressive and saying they don't want give them 10 months, want to give them less. And so, look, there's a lot of people against these companies. There always has been, there always will be. And so, anyways, because of all of that, Gottlieb is coming out and he's using this as his platform again to preach his message. But again, he's not in charge anymore. He's gone from the FDA. And so, that being said, the way the media positions all of this, it's as if the world is going to come to an end as it pertains to these companies. What else is bad? Well, we talked about BTI a bit. When Mr. Gottlieb was in the FDA, he was trying to ban menthol. We'll see what happens on that. Another bad thing is there is this whole country of Brazil now is coming after these companies. They're coming after Philip Morris International, another company I own. They're coming after BTI, and they're saying, hey guys, because of the impact you've created on our healthcare system, we're going to sue you, and we're going to recover costs to treat patients who have been affected by the products you sell. And so anyways, bad, bad, bad. This is why I circled it. Bad. And the media, they just have a field day with this kind of stuff. But there's actually some good news, and the good news doesn't get much press. That's the funny part. The good news, no, we don't hear anything about it. So Altria, for example, they acquired a cannabis company called Cronos. This, I think, is a very good step because as cannabis gets legalized nationwide in the United States, hopefully that will happen at one point in the future. If that does happen, they're going to be really well positioned with their acquisition and with their distribution to be a major player in the market, if not the player in the market, which could take their business completely to the next level. We don't hear the media celebrating that at all. Not at all. Maybe you see it on Yahoo Finance or you see it on an investment website, but you don't see that. Another one, this one no one's heard about. I bet you if you're here and you've heard of this, Thug Life, because you know more than I do about this market, and this is a market I follow really closely. I heard nothing about this until I was actually researching for the video today. So I knew for a while Philip Morris International, they sell a heated product, not a combustible product, but a heated product. This is a new innovation in Japan, and it does really well because it's a lower risk product, lower risk alternative. Now, they actually got FDA approval to sell this thing in the US, not Philip Morris International. Their sister company, Altria, will be selling this heated product in the US. They got FDA approval, but the only caveat is they're waiting to actually start selling it because they're trying to get a lower risk labeling, a marketing message approved by the FDA that they can market as lower risk, because if they can, they'll sell even more, and it'll just hockey stick like it has in the country of Japan. And so I was waiting for them to get approval on this. I've been waiting for a year probably, thinking, when are they going to get approval? Hadn't heard anything until I was researching and like scrolling way down in the news, found it hidden in some article when I was looking up heated products. No one heard about this. Media doesn't celebrate this. Media has no idea about the impact that could have on Altria's business in the United States. Well, Altria's all United States. Huge impact on Altria's business. They're not talking about the good stuff. I'll tell you another interesting thing. These companies, the media would leave you to believe they're going to go out of business, but did you know in 1998 there was a master settlement between these companies and the United States? The various states ganged up against them, and there's this master settlement. The master settlement agreement has these companies paying out $206 billion over the course of 25 years. Let me repeat this. They got sued by the states. They settled. Hey, we're going to pay. We're going to pay. They got sued for healthcare related costs. We're going to pay $200+ billion. They survived a $200 billion settlement. And we're worried about this bad stuff? This is the background. This is the context. The good stuff, you have to remind yourself of the good stuff in a crash situation because the media sure ain't talking about it. And so anyways, I don't want to spend too much more time on this, but I get this. This is going to be a really nuanced, layered video today, so hang with me. It goes into a lot of deep stuff. First thing I want to talk about here is, Ian, what's the crash like? This is what the crash is like. You want to prepare for the crash? Look at this. Maybe you don't even own it. Think about how would I feel if I owned this stuff? Because I'll tell you right now, I own it. It's 11% of my portfolio. I'm not buying more, although I have in recent months. We'll get to that later. I'm reinvesting my dividends. But even lately myself, the negative stuff, it's just been beating on my door, knocking on my door. And it's starting to get to me even, and I've been doing this a long time, a long time. So I'm trying to tell you, when the crash really does come, and it affects maybe not just sin stocks, but everything, that negativity is going to be so deep that I don't care how good of an investor you are, how long you've been doing it, it's going to affect you, it's going to affect me, and that's what you got to prepare for. And I think this is a microcosm, this is an example right now that we can all live to prepare ourselves for that crash scenario. Because the wise dividend investor, love this stuff or hate it, needs to understand the game that's going on. That if the sentiment is horrible, but you can still get a solid company with solid numbers at a reasonable discount, but yeah, there's some bad stuff, but you're pricing the bad stuff, you're pricing the risk. That's what it's about in terms of being a really solid long-term investor, long-term value investor, long-term dividend investor. That's how I like to approach a crash-like scenario, and it's how I like to look at it objectively. Like, what are the levers here that are affecting this price of this stock, and am I being rational about it, or am I letting these guys get to me too much? Now, you may believe that all this bad stuff is going to come to fruition. That's a whole different side of the coin. Personally, I think there is a lot of risk with these things now, so I don't want to sugarcoat it. This is a very risky segment of the market. I don't want it to be 11% of my portfolio. I want it to be more like 7, because I'm a bit over allocated. I have a bit too much risk given where I am as an investor. But when I was a younger investor back in the earlier days, I think circa even 2009, when I was rebuilding our portfolio, rebuilding the portfolio after a home purchase, I went nearly 100% in sin stocks. So at that time, I had a different persona, investing persona, than I do now that we have 2 kids and we're a bit further along in life. I can't be so risky, don't want to be so risky. So anyways, microcosm of what the crash is like. But I want to move on to another topic, because this whole sin stock stuff that's going on right now, it teaches us something else. And what it teaches us is dividend riches. Basically, if you can look past negative sentiment and you can take calculated risk, this is kind of what separates the dividend riches from the slow and steady path. And I'm not trying to advocate one or the other. These days, quite frankly, I'm more of an advocate of the slow and steady risk, lower risk path, because that's where I am in my life. Don't want to take on as much risk. But not just about 10 years ago, actually, I was more in the camp of dividend riches, get rich quicker, take on a little more calculated risk. And so what does all of this tell you? Typically, we talk about it on the channel. There's 2 types of stocks. There's the ones that have the lower dividend yield but grow it quickly, grow the dividend quickly. Stocks like 3M. Gonna take some time to get rich, but it'll compound, give it a few decades. Great. There's other types of stocks like utilities, regulated electric utilities. They pay a really big dividend right now. They're not growing very quickly. Not huge risk, especially if you diversify. But again, not going to get rich overnight. There is a class of stocks in the middle. There's a class of stocks that have a high starting yield, but they're also growing the dividend quickly. For example, Altria has a compound annual growth rate of the dividend of about 11% for the last 5 years. So on average, they're growing the dividend 11% per year. And they have a starting yield right now of 6.67%. So what I'm trying to say is, if you are an investor who can live with calculated risks, there is a class of dividend stocks that have the high starting yield like the utilities, but they have the high growth rate as well, like the 3Ms of the world. And you put those together, it can create dividend riches. It can get someone rich on dividends quicker, not having to wait decades, maybe having to wait 1 decade. And so that's worth pointing out. Again, it's about being very calculated, being very cognizant of what it is you're trying to accomplish. And so really the message here is, I'm not advocating, hey, let's all put 100% into sin stocks. By no means do I advocate that, even though I did do it in my early days. It is very risky what I did. But what I'm just trying to say is that there are different platforms out there. There are different models. There are different ways of doing things in dividends. There are some people that go all in on the high yielders, low risk ones because they just want the cash flow now. There's some people that go all in on the 3Ms of the world because they know that they're going to retire in a few decades and they're just going to let it compound. Then there's people who may go with something like this, knowing that they want to retire a little quicker. They want to do it in less than 10 years or maybe around 10 years. And then there's people like myself who mesh it all together and kind of bridge the gap, do it all. Although I'm progressively getting away from this kind of thing, I'm more of the person these days that mixes the utilities with the 3Ms of the world, gets the yield, gets the growth, keeps the risk a little bit lower. So that's kind of my persona these days. But the homework, if you are a dividend investor, is to go home and think, what kind of box do I fit in? Do I fit into a bunch of them like Ian? Am I a risk seeker, like the kind of person that would go after this stuff? Am I a yield investor who's the kind of person that goes after the utilities? Or am I kind of the dividend growth investor who goes after the 3Ms of the world? Or are there a few check boxes I want to check off? And so that is kind of the homework. That's the takeaway from something like this. But again, riches, it is this firsthand, I'll tell you, this is how I got my start in my most recent portfolio. Look, I've been investing over 20 years, but a few times here the portfolio has been depleted for down payments on residences. And so in the most recent iteration of the portfolio, one of the ways I kind of jump-started it was taking on some of that calculated risk. And look, back in 2009, it was kind of scary to invest in this stuff too. And it was in, look, I bought, I don't even know if I listed it here, but way back it was around, $15 or so. I'll look it up. I'll put it in the description below. But my initial purchase price of Altria is somewhere in that circa $15 range. It was scary back there buying at 15, but look, we're at 48 now, and that's after the thing has fallen, and that's just an indication. And my yield on cost on that first tranche I was buying back in 2009 is 20%. Simple yield on cost, not even counting reinvested dividends. And so that's dividend riches right there, calculated risk. But some people would say this time is different. The Gottlieb is right. They're going to take these guys out. The Brazil thing is a big threat. There is that opinion as well, and so you have to weigh what you make of it all. That's the key. You have to believe in your heart. You have to do the research. You have to live with your investment decisions, and so it's a tricky one with these guys. I'll tell you, even right now, I am reinvesting all the dividends, but the media's gotten even into my head a little bit. So sometimes when the media does get into my head, what I like to do is look at the facts. I like to look at some of the numbers. And so I want to do that next. But I also want to go through these numbers because they paint a picture of dollar cost averaging and why I like to average in over time and why it's a little riskier to deploy just 100% of money at one time. So let's look at this. Altria, ticker symbol MO. I show my history here of my purchases over the last few months, going back to kind of the end of 2018, and I've been both reinvesting dividends, but I also made a net new purchase as well, which is rare for me in this industry because I'm trying to lower its allocation in the portfolio, but the value just got so good that I went for it. So anyways, in October last year, I reinvested dividends at $62. That's pretty high. Look, if I went all out at that point and bought more, that would be risky because it's gone down from there. And that's why I like to buy on a regular basis. I like to dollar cost average. So looking at January this year, I reinvested dividends at 48. So the first two purchases here are dividend reinvestments. First at 62, then at 48. Now also in January this year, it dropped more and I actually bought. I bought shares at 44.72. Then again in May this year, I reinvested again at 54. When I average all this up, just simple average, I didn't weight it. Though actually when I bought, it was actually a reasonable lot. But anyways, I just do a simple average. I get to $52. And so the point here that I'm trying to illustrate is just a separate topic of this video, but a related one. When I invest in a riskier market, really any market, quite frankly, I'm talking about a riskier segment like sin stocks, or just a market like we're in that could be kind of top top heavy, a little volatile. I always like to average in over time because it optimizes my risk. It lowers my risk. It lowers my probability that I deploy all my money at the top. And so this is an example firsthand where you average all these together, you get a reasonable average. But if I put all my money in at the top at 62, that would have been very tragic. And so anyways, the current share price is 48. It's still lower than my average. That's okay. That's okay. And I'm talking about my recent average. Like I said, back in 2009, I started buying at 15. But I want to talk about some metrics here. The yield, the starting dividend yield right now is a 6.67%. But the compound annual growth rate of the dividend over the last 5 years is 11%. And so, like I said, this is one of those rare cases where it's got the best of both worlds. High yield starting, high growth rate. Usually what that means is if someone takes calculated risk and it works out for them, look, it doesn't always work out. It may not work out this time. That's why I'm trying to limit my own risk in this sector by trying to lower my 11% to 7% over time, my allocation. But if the calculated risk pays off, that could yield dividend riches. Now, the PE, I looked at the analyst estimates for this year. How much will they earn in 2019? And I calculate the PE ratio. I take the current price, I divide by the analyst expectations. I'm getting an 11.46. And so this is starting to be, again, in deep discount territory. Buying anything of world class in this market at a PE of 11, starting yield over 6%, fast dividend growth rate. I start looking at the numbers like this, and I start forgetting this, the horrible sentiment. And so this is just another trick that I use. When the horrible sentiment sometimes gets to me, I will just look at the numbers and I'll let the numbers tell their story and reassure me of what I'm doing. Because at a PE of 11, what I kind of think is the risk is already priced in. Hey, volume of the product, the traditional product they sell is going down. Oh no, they're facing challenges with the JUUL acquisition because the FDA is going to make them get their product approved. A lot of stuff going on, this and that. The good stuff everyone forgets because no one talks about it. When I get in that frame of mind, for me to continue to take calculated risk and just manage my portfolio, I just run the numbers. And so look at BTI. I was buying in or reinvesting dividends in November last year at 34 bucks. This one's been more consistent. In December last year, I bought some shares at 34 bucks. In December last year, I bought more shares at 32. In February this year, I reinvested at 36. And in May this year, I reinvested at 37. It's now at 34. And so it does give kind of a picture, though, again, this thing has been moving around. And if I just saved all my money and I just bought it all in May this year, I would have bought at the recent high or relative high. But because I dollar cost average, my average comes out to about 34 bucks. And it's at 35 right now. And so my average comes in nicely. And so again, how I approach dividend investing overall, but also a risky subsector, is I like to just average in over time. And you see here, even with this one, I didn't buy once in December, I bought twice. I even spread the money around a little bit. Well, quite frankly, I probably didn't expect to buy twice. The reason I did it is when it notched down to 32, I'm like, hey, back up the truck. This is a buying opportunity. And so anyways, the price per share now is 35. The yield, the starting yield is a 7.64%. I don't have a forward PE on this. I couldn't really find analyst expectations on this, but a trailing PE is in the 10 range to the best of what I could find. The data is a little harder to run on this one, being a UK-based company. And so as a US citizen investing in dollars, it's a little harder to do all the conversions and such. But the research I did showed me that the PE is at about a 10. And so the question becomes, hey, they face challenges with menthol. Well, they're going to figure that out. And for a PE of 10, I think the risk is priced in. Hey, they're going to face challenges in Brazil potentially. Look, whatever Brazil dishes out at these guys, it ain't as bad as a $200 billion settlement with the U.S., with the various states. And so And so what I'm trying to explain here is I look at the data, and one, I love the dollar cost averaging. That's just a side note, side story here. But the rest of the data, what it's showing me is, hey, numbers are good, risk is already priced in. But what I want to end with here is, I don't know if you can even see this, but I underscore dividend investing, quite frankly, is not easy. And so a lot of the time we're talking on this channel, we're happy, we're excited, market's been doing pretty well. But what I'm trying to say, for people who truly do well in dividends and get real meaningful cash flow over the long periods of time and have been through crashes, this stuff is not always easy. And I hope the microcosm today, the sin stock category, kind of gives an example of why it's not easy. It's not easy, quite frankly, because you may own something that is tanking, like some of these stocks I own now. And not only is it tanking, but what the media is saying is making you doubt what you're even doing, because they tend to oftentimes look at the bad, not look at the good. And so dividend stock investing, it's not easy. And the reason it's not easy is because the whole strategy hinges, in my opinion, on buying and holding forever. And it's multi decades where the real magic happens, although with something like this, potentially calculated risk could pay off in a lot less than 1 decade, as it has for me historically in this sector. But again, for dividend investing to work, typically it takes the conviction to hold for long periods of time, and not only hold, but add to positions when they're down. And that's very hard, because what happens is this media effect on a lot of investors, it forces them to sell. It not forces them, but it convinces them. No one's forced to do anything, but it convinces them to sell good companies at low prices. And there are so many investors out there that make this mistake. They make this mistake that they get scared from something that they made rational decisions to own. They forget to look at the numbers again. They forget this entire framework. They focus on this one box, the horrible sentiment, and it gets to them. And I'm telling you, it gets to me sometimes to this day, and I've been doing this for over 20 years. And so this is a reminder to all of us, because the crash will come, the recession will come. When it does come, there's going to be more of this, not just for sin stocks, it's going to hit other categories. And when it does, remind yourself, maybe there are certain pockets where it makes sense to sell. I'm not saying never sell. You have to make up all your own decisions. I'm just sharing my personal journey here. But what I am saying is, before anyone ever sells, it's always a wise thing to take a step back, forget this box for a minute, the horrible sentiment, and look at all of the other facts. And also remember riches. How did people get rich with dividends historically? It is not easy. It's by taking calculated risks. It's by, quite frankly, diversifying as well. A lot of people are against diversification. One of the reasons I do diversify is it takes some of the heat off of me. If I was 100% in this stuff right now, this horrible sentiment, it would get to me more. There'd be a lot of, feel like the media's kind of got a stronghold on me if that was 100% of my portfolio. But because I'm diversified, I can switch my attention to other sectors just to kind of let this stuff be, let it do its thing, forget about it, set it and forget it, and focus on other things that aren't facing that horrible sentiment. So I love diversification because it lowers the psychological propensity to listen to the media and to sell good stuff, but also just from a risk mitigation standpoint, what if the media is right? What if this stuff is going downhill? Well, the way I look at it is I got 11% of my portfolio in this. Let's say the stocks from here get cut in half. They're facing bad problems, they get cut in half. I'm only facing like a 5% downside on the entire portfolio. I can easily make that up in less than 1 year on the rest of the companies I own. And so that's one of the ways I look at diversification as well. Surely I don't want to lose half the market cap of these companies. It would be a big hit. But again, in the scheme of things, 5% down on the pie, it's not the end of the world. I don't think these companies are going to get more than cut in half. And I don't even think that will happen. But I'm just saying that is one way I evaluate and look at the risk. And so I would be curious, taking a step back here, what do you guys think about the sin stock category here? Do you think the media is right? Do you think that they are wrong? I'll tell you, there's so many games these days in the media. There's so many popular opinions that you take at face value, you take it fact, because it just is out there, and you kind of assume that that's the popular opinion. But there are so many other opinions out there, like this good news, Kronos, like the heated products, that don't really make it, and so it just skews your opinion. So I'd be curious, what do you think about sin stocks, but also what do you think about the impact that the media has on investors, on your investing, and just the investing public in general? Key point of this video is, as the everyday investor, this is dividend investing for everyone. I don't care if you dislike sin stocks, you're in something else, it is all good. But what the point of the video is, this is dividend investing for everyone. I'm trying to basically educate the everyday investor to be more savvy out there and to avoid some of the mistakes sometimes that the everyday investor makes, because unfortunately all too often the everyday investor buys at the top, sells at the bottom, and it is not something that obviously is a working strategy over the long run. Anyways, thank you guys so much for watching today, celebrating my video number 200. I am really tired, exhausted. It's Friday night, midnight, doing this late at night, quite frankly, because of your support. It is because of your subscriptions, the kind words that come through on Twitter, on Instagram, on YouTube. I love you guys. Thank you for the support. If you want to thank me for these videos, the best way you can do it literally is hitting that subscribe button, hitting the little bell too that alerts you when the new videos come out. I'll tell you, I look at my YouTube stats and I'm still getting a huge chunk of people watching it who are not subscribed. And it's probably, quite frankly, because a lot of these people do not have a YouTube account or a Google account. I encourage you, if you take the time to have a YouTube account, to actually subscribe to my channel. It's literally the best way you can thank me. It means the world to me. Helps me out. We're close to 30,000 subscribers. I want to surpass 30,000 and go much further. And I also want to thank you. I'll tell you something. The momentum on this channel has been building up a bit lately, and it's because of all of you out there. It's because of what you are doing to support this channel. It is working. It means a lot. I thank you so much, so much. And before I leave today, a full disclosure, I own the stocks mentioned today. I am long 3M, ticker symbol MMM. I'm long Altria, ticker symbol MO. I'm long BTI, ticker symbol BTI. And I am long Philip Morris International, ticker symbol PM. I own those stocks in my personal dividend stock portfolio. Before we leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed financial advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here for your fun and entertainment. And if you want to see additional disclaimers, I got some in the description below as well. And so always make sure to check out my descriptions and check them out just because they have cool info and timestamps. All right, everyone. Happy celebration here for 200 videos about dividend investing. I can't wait to do the next 200. By the way, one of my subscribers today said, Ian, I would rather watch your videos on YouTube than watch Netflix. And this is one of my subscribers from Japan. Thank you so much, my friend. That really, really means the world to me. And honestly, that's why I decided to stay up really late tonight, get this thing done, even though I should be sleeping right now. I really appreciate it. All right, guys, I'll see you in the next video.